On the Tape is presented by CME Group, where risk meets opportunity, and iConnections, reimagining how the investment industry connects. Welcome to the On the Tape podcast. Guy Adami, always joined by Dan Nathan and Danny Moses. Today, the penultimate podcast of the year. If you don't know what it means, go to your Google machine. We're going to talk about a little PCE, because why not? These 0 days to expiry options. China, Taiwan. By the way, it ain't just me talking about it. Apparently, President Xi and President Biden spoke about it a couple weeks ago. What do I know? Some economic data. Danny's got his stuff. How are you, Dan Nathan?
I'm doing what? Penultimate. So that's second to last. Is that what we have going on here? Danny, did you know that? Penultimate? That's like a good SAT
I did. The
word.
way that he said it, I figured it out quickly. I could put that puzzle together.
Yeah, we're
happy
smart
birthday
guys.
again.
Well, thank you. I appreciate that. And, you know, Wednesday of this week, Dan, we saw something extraordinarily interesting and rare happen. Market actually sold off. And it sold off in a rather aggressive way. And Danny has some thoughts on that. There's been some work done over the last couple days trying to explain it. But you know what? We're right back. I mean, we're right back here. I mean, it makes you think of certain things.
Well, I know.
Sure.
I mean, like it just, you know, Danny, we have this like really sharp, and no one can put their finger out. There was no tape bomb. There was nothing, you know, fundamental that was out there, right? And when you see the S&P reverse from being green on the day, I think it was like the 10th up day in like 11 or something like that, in an 8 consecutive week rally, right? So we know there's not too many more trading days. We know that we've just defied a lot of logic and gravity at this point. To see that sort of intraday reversal, you know what I mean? You want to figure out what's going on. The fact that here we are Thursday afternoon and we're right back up. I mean, I'm just thinking Brokeback market here, buddy. Like they cannot quit this thing. They cannot quit stocks. They cannot quit this bull market in 2023. I don't know, Danny, like talk to me. Like when you saw that happening, and it seemed like a cascading effect too, right? Because it was in a lot of the big names got hit really, really hard.
I think because they're the biggest weights in the S&P, but how dare the market go down ever, right? People, you know, what's really amazing is, you know, I'll talk about some of the notes that have been written in the last 24 hours about this, but the fact that, you know, we only hear about it when the market obviously goes down, not up. We've had this happen, tons of volume, 0 dated to expiration, single names, you know, on indices and so forth. And so it caught people's attention when it goes down, because then it's a problem of some kind. But David Boole over at Baycrest, who writes a daily option note, I think Dan really nailed it. And I think when you mention those big names, I think that's just a product of them being heavy weights in the S&P going down, but there was certainly a lot of activity. And one other thing of note is that just on the VIX in general, 2 things that I noted. The VIX has been it can only go so much lower, right? But it's been going up even on the days where the market was higher. And the interesting break yesterday to me was that the 10-year yields were down 7 to 8 basis points and the market was down. That was the first time that we've seen that kind of work together, or against each other, I should say. So yeah, Dan, I sent that note to you from Baycrest. You know, I know you had a chance to look at it.
Yeah, no, I thought it was a great description. What I loved about it also is that, you know, for years, and we've been talking about it on Fast Money Guy, you and me, we've been talking about it on the tape for the last 3 years. Like people who are so certain of what they think is going on in the options market based on big prints. I've been on these desks. We've all been on these desks. We've traded these products. Oftentimes it could be a hedge against something out. It could be something, a roll. It could be a spread. It could be, you know, your risk manager tapped you on the shoulder and you do the thing with the least amount of notional value that basically at least gets him or her off your back for a little bit. What was interesting about this note, though, is that, you know, Boole just highlights the fact that, yes, there were 2 large prints in the dailies. This started at 2:30 in the afternoon, right? Height of complacency in the markets, because we had kind of been melting up for the last few days or last few weeks late in the afternoon. But he highlights the fact, maybe it was a spread, maybe it was this. But the way that these puts were bought, okay, and the way that the dealers who are on the other side, who are probably equally complacent for a little bit, what they have to do to hedge, whether it be in other expiries that are longer dated that don't expire to cash at the end of the day, maybe it's in futures, maybe it's gamma hedging, a whole host of other things without getting too far in the weeds. That is the sort of thing that could cause the sort of movement that we had. And so who knows, you know, we're going into expiration on Friday. There's a lot of things that could happen all at once that has the ability to turn this into something more than just an hour and a half sort of thing, which leads me to the point, the Brokeback market thing is like, they can't quit it. They're right back to them. They're ripping them, right? Like a lot of the stuff that got hit 2-3% is up 1.5-2%. You know what I mean? Like it wasn't enough to put together a string of a couple days, but it also leads me to believe that sometimes you just get these funky sort of things, that somebody thought an opportunity to put $20 million in notional and they were willing to test a strategy to see what would happen. But that could also portend to some really scary things that happens in the new year.
Are you familiar with the name Dan Willie Dixon?
I am not.
It's unfortunate. Danny Moses, I'll ask you the same question. It's yes or no. Please just indulge me.
No, I don't think so.
No, you're not.
Not right off the top of my head.
What I'll say is Willie Dixon wrote the song, I Can't Quit You, Baby. And as you both know, in 1969, the debut album of Led Zeppelin contained the song, I Can't Quit You, Baby. And that's where we are. That's where my mind goes. And by the way, I believe it was 1974, not that anybody cares, was my first introduction to the aforementioned Led Zeppelin. I believe I was 10 or 11 years old at the time. But to Danny's point, and I think this is important, when the market's going higher, and it's pretty clear that these 0 days to expiry options are contributing in some capacity to it, nobody says a word. But on days where clearly they had some hand in this going lower, everybody becomes somewhat apoplectic and they're looking for somebody to blame. What I'll say is this, Dan, and I believe this in all of my heart, these people behind these are market agnostic. As a matter of fact, if you were really to ask them, things go down a lot faster than they go up. So if they can sort of tap into something on the downside and start to make money, to your earlier point, be very careful because they might have just unearthed something moving forward into 2024.
Yeah, and Danny, this is one of the things when you look back to some of you remember in the throes of the sell-off in March of 2020 where, Bill Ackman came on CNBC crying like you know what I mean? And he had that big trade on and he was like, hell's coming with us, all that sort of stuff. I mean, a lot of those folks use very sophisticated options trades that are across different products also. They lever them up maybe with options. They're using futures. They're doing a whole host of things. The whole idea is to put as little money to work with defined risk that have the potential to, and I don't want to throw words out like convexity. You can go Google that. People that have the ability to actually explode in value, right? And I guarantee you some of the smartest minds on Wall Street are taking a very close look at what happened yesterday in 1 hour, right? And if you look at the notional that was put to work and the potential of the profit that could have been realized by year end, those are the sorts of things where people are trying to look at the market structure. And Danny, you've been talking about this for months and months and months. The market structure and some of these new products have the potential to cause an uncertain amount of volatility. And if everything comes together at once, that's how you get the sort of meltdowns that actually break the back of some of the movement or the momentum that we've had over the last, call it 2 months or so.
Yeah, and it's not just human mind, it's the computer mind, I think, that picks up on these trends. And I've talked about for years now, the lack of the brokers being able to hold and provide this type of capital is going to create this type of volatility, right? So hedges normally could be done, over the counter behind the scenes at some of these big Wall Street banks. That's not happening as much anymore. You see names like Citi, which are closing down their high yield desk, right? Which I'm sure had done a lot of hedging, during the time. But let's keep in mind, I do think that there is a manipulation aspect to this option that I think some of these models have figured out, not necessarily with the S&P trade yesterday. You think about all the single name options we've been talking about and listen, calls and puts you can push around. But there are certainly ways, especially on low volume weeks like we're supposed to be having right now, where you can certainly push around just single names and some of these indices for sure. So, I use those as an advantage to the downside and to the upside. When you see those occur in single names and you own a stock, sell into it. If you want to buy more of a stock and it's a kind of a put parade, then buy it, right? So just be aware and use it, kind of as a technical into your fundamental analysis, because volatility is here to stay. And these type of option trading that we've seen, no one's going to take away these 0 day to expiry options. They are here to stay. Believe me. SIBO's come out and said how great the product is, and they think it creates efficiencies in the market. So it's not going anywhere. So get used to it, I guess.
But it does have the potential to actually add, other, like, let's say, margin requirements and the like. And that's one of the reasons why so much retail has been attracted to it.
The other thing, Dan, that people are looking at is the condition of the market. We talk about market but the market in terms of indicators, and one of the things everybody looks at is something called the Relative Strength Index, the RSI, and it's at levels in terms of overbought that we haven't seen in quite some time. And a lot of people, myself included, thinks that portends obviously to a pretty meaningful sell-off. Now, earlier this week we saw that, but there's a counter to that, and Ryan Dietrich, who does extraordinary work, he put out a tweet earlier this week. More than 40% of the components of the S&P 500 have hit an RSI greater than 70, which is on the higher end of things in terms of RSI. And he says this is a super overbought condition. However, we have seen moves like this. We have seen indications like this in January of 75, October of 82, February 91, July of 20, and now. And all the times and those indications that the market was up some 25.5% on average in the wake of that. I'll say this. He might wind up being right at the end of 2024. The problem, of course, is how we get there, Danny. And I'm telling you, when you overlay an RSI that was north of 82 for the broader market, on top of this fear-greed indicator, which is flashing red on the greed side of the equation, on the backdrop of an S&P 500 that's effectively retraced the entire move from December of 2021, you got a bit of a witch's brew. Not least of which, what also happened on Wednesday was the news wires picked up that earlier this month, President Xi and President Biden spoke, and President Xi told President Biden that they will take over Taiwan by any means necessary. Not my words, his. So throw all that into the mixer, Danny. Put it on blend, and what type of drink do you come out with?
A bearish drink, bearish cocktail. No, certainly, again, we talked about this. Geopolitics is underpriced. I think that the bull bear, those are pretty certain things over a period of maybe even days or at the most a week when you get those type of extreme bullish signals, right? Just be honest with yourself. And here's the other thing I'm noticing. All the pundits, yes, that are taking victory laps that had these calls and everything. People are now not just apologizing if they were bearish, separate. Broadcasters are saying, with the market trading down yesterday, let me just say, and I'm not bearish by any means, but is that a sign that maybe the market's a little overbought, or the market sold off? And by the way, I think it actually might be a buying opportunity, but people are so scared right now to make any bearish call at all. On top of what these indicators are saying, I'm just noticing in the public because everybody's on board. And I think we saw an article come out in the last couple of days that more retail investors own the market than ever before. I think it has spread through the entire demographic. So something to take notice of also. It's not that it's a bad thing. It's that it's accessible, which is great. But I think it's become part of people's everyday life. And I think that's something to really consider here as we turn the calendar.
Yeah, and to your point, Guy, about the RSI, so the last time we saw a reading this high, it was in mid-July. That coincided with the S&P getting to 4,600 and topping out there and having a sell-off from 4,600 down to its lows in October at about 4,100 or so. So here we are. We went from October 27th, 4,100, just to about, 4,750 or something like that. And one of the things that I would just mention about all that complacency that you're talking about, guys, so we also had a VIX that kind of stopped at 12. Did you guys notice that? It didn't melt down, right? And this is also where, we've had rates. I thought this was interesting yesterday, that yesterday was the lowest close on the 10-year since, I want to say, the summer, like mid-July also again. And so you've been making this point, Guy, that at some point, a further precipitous drop in yields might be not perceived as positive for stocks, positive for the economy. What is the reason why they continue to go lower? So yields were down and stocks were down. This was Wednesday afternoon. So I thought that was really interesting. The other thing I'd say is that, when the S&P broke out and made a new 52-week high, I want to say it was about December 11th. So here we are, we're recording this on December 21st, right? And so we had this near 4% melt up, right? So it kind of felt a little bit like window dressing, a little bit of a chase. So going back to the activity that we saw yesterday, it didn't take a whole heck of a lot to disturb the apple cart. And the last thing I'll just say is if you are bullish, heading into 2024, one of the best things that might happen is a VIX in the high teens and an S&P back below 4,600 in the not so distant future, because at least what it does is takes a little bit of the froth out. Because I'm talking to friends of mine who are on the other side of my bearish call in the S&P 500 who've been very bullish, who are thinking, they're getting a little nervous right now because they're thinking things are overheated. And when everybody's back in the pool, we generally know what happens.
I look at this, Danny, and there's so many things to be concerned about, and the things that I've been concerned about have not gone away. They've not been mitigated in any way, shape, or form. In a lot of senses, they've gotten worse. I'll mention this, and I know you look at this pretty closely. If we get to February, which is effectively 2 months away, Danny, and we still have an inverted yield curve, which really appears to be the case because I think we're about 50 or so basis points inverted now, that will be the longest duration, I think, since they started looking at these types of metrics. Historically, and you go back and look, the longer the inversion, the worse the downturn is. And you have so many people out there, Deutsche Bank, Wells Fargo, Citibank, all these strategists coming out and saying there are things to be concerned about. And the one thing that I look at, and it keeps coming back to me, is because nothing's happened yet doesn't mean the inevitability of all this is not going to happen. And I'm surprised that things haven't sort of taken hold sooner. But, you read from Citibank, Andrew Hollinsworth, we think the effects of higher interest rates are finally having the expected effect of slowing the U.S. economy. We see increasing signs in the labor market, something we've talked about, including a rise in unemployment rate and continuing jobless claims that suggest hiring will slow. I mean, I can go on and on. My point is this. All the things we've been concerned about are still there. The fact that they haven't sort of come to fruition in terms of the market doesn't mean it's not. It just means I think the inevitability has just been pushed off a little bit. Thoughts on that?
Well, what I have a problem with reconciling here is people that are, calling for 10 to 12% S&P earnings growth next year and a slew of rate cuts. Something about that just doesn't work for me. If the Fed's going to be really aggressive next year, it's not because earnings are accelerating. It's because things are massively slowing. And can certain companies, maybe in the energy sector as a one-off, which is not big enough for the S&P to drive some earnings growth? Yes, but I just don't see those two things marrying. So when you start to see forecasts of double-digit earnings growth and the Fed cutting 5 to 6 times, that doesn't work for me. To your point you make about an inverted yield curve, I would look at it this way. If we basically steepen and de-invert, if I can use that word, it means that the Fed is aggressively cutting because the 2-year yields that we've seen, which they kind of control more of towards the shorter end, have now dropped to basically 4.35%. So what could happen? That 2-year yield starts to drop to 3.25, right? And maybe things are slowing dramatically down and we stay inverted and the 10-year just keeps pushing lower. But here's where I was actually talking about this with someone yesterday. You start to think about, again, what the problem was 2 to 3 months ago. What is the credit worthiness of the U.S., right? And you look at Germany, which the 10-year Bund has now dropped below 2%. But I looked at it, and I'm like, their debt to GDP, I think, is around 65% or something in that realm. It doesn't scare you. In the UK, it's 1-to-1. So it's a little bit higher. But here, we're 125, maybe 135, maybe even 140 debt to GDP. So when yields are low like that under being pressed, you figure it's cyclical. But if our yields can't go lower because there's a secular, then all bets are off. And this, you can be, and I don't even want to put my brain there. So I guess, Guy, a long-winded way of answering your question is a lot goes into figuring out if you gave me the yield curve, whether it was inverted or not, right? And what those, I would have to put the puzzle together. I just don't see a situation where I can see earnings growth with lots of rate cuts.
Yeah, the one thing I'll just say as far as the rate cuts are concerned, and one of the biggest takeaways I had from Fed Chair Powell's presser last week is that he was asked the question, listen, everyone is focused on this kind of, mission accomplished sort of thing, right? He said that we are going to start to cut rates before inflation gets 2%. He didn't say that inflation is definitely going back to 2%. He didn't say give any timetable. We looked at the dots. We're expecting, 3 cuts next year. And so I respect that. That is what the consensus is right now. That is essentially calling for a soft landing, that they don't want, if inflation drops faster than expected, they don't want their policy to be too restrictive. What are they worried about? Well, if it's too restrictive, then it has the potential to slow the economy at a greater pace. But all of that means threading a needle, right? And so I guess I have asked almost every strategist that we have had on Fast Money, on the tape, on Market Call, is that just again, in my career, when the Fed, after a rate hiking cycle, then they pause. That's the period that's been great for stocks. That's what we've been in this year, right? Because we've had this 23% move in the S&P 500. It's when they start cutting, right? You might think, well, that's great for risk assets, but when they start to accelerate those cuts, because that's what happened in 2000. That's what happened in 2007. It's obviously what happened in 2020, while that is a fairly unique sort of scenario. So that's the thing that I'd worry about. And that's the disparity, in my opinion, between what markets are pricing right now for a soft landing and then the point, Danny, that you just made is that sort of unexpected. And I want to make one last point because on the geopolitical thing, on President Xi and what he supposedly said to Biden about Taiwan, we have a very special On the Tape podcast that's going to drop on 26. You call that Boxing Day, don't you, Guy?
Of course, I'm a big fan of Boxing Day.
Yeah, you are. There's probably some good. We got to talk about Danny's Premier League pick. I mean,
Danny Moses said there was a bet to be made. A draw as an outcome is a bet you wanted to make. And I actually texted the group on Sunday, not that I watched that shit, but there was that must have been a scintillating match.
0-0
on the pitch.
Was it
but Danny Moses nailed that one.
Yeah. But on Boxing Day, we have Mike Novogratz, who's the CEO of Galaxy, legendary macro investor. We spent a lot of time on the macro, and it's interesting, and we obviously talked about crypto and his expectations for that going forward. But he had some really interesting, Guy, and non-consensus commentary about China and Taiwan, and it was actually really thought-provoking. It led me down a couple of rabbit holes. We'll let you guys listen to that on Tuesday, and maybe we'll address it again next week on the final.
100%. And you should listen because we actually, Danny, you brought up debt to GDP here in the United States. It was Mike Novogratz who years ago in a conversation that I had with him said, no developed economy in the history of mankind has been able to recover from debt to GDP levels of about 130%, yet here we are now. So you should listen to that podcast, which drops on Boxing Day. But I think we had a similar conversation, but I think we all think about different outcomes here, Danny. But you are correct. And, it's interesting to see also quickly, Danny, Bank of Japan, I think they sort of surprised some people, staying as dovish as they are. They're staying with the negative interest rate policy, which is fascinating. And I got to tell you something. You still have quantitative tightening going on here, and we're still a long ways away from probably where the Fed's balance sheet should be. Some thoughts on that?
When in doubt, I guess just pick the dovish side of things to any central bank in the world. I want to make a comment. So I was talking to Porter and Vinny just about Powell's kind of Christmas pivot, whatever they're calling it these days. And James Aiken, who's a brilliant guy, runs Aiken Advisors. He talks to just a brilliant group of macro traders. And the thought was that Powell has someone in his ear, that whether it's private credit, whether it's the CLO market, similar to what happened 2018, whatever, when the fear came back to the market, said, hold on here. We're rolling the calendar in 2024. Yes, the stock market's up. Yes, inflation's come down. There's some issues here. And so we need to get kind of ahead of this because to Dan's point, people are trying to explain, why would you be so aggressive, turn so dovish and lose that credibility? And God forbid now that inflation pops back up again, it's not going to have much left. But yeah, Guy, on Bank of Japan, they had an opportunity here again to basically say and they may do something on this NERP come the next meeting in January. But you saw what happened. I mean, their 10-year yields, right, have gone now back below 0.6%. The yen initially after that obviously got weaker, and now it's actually strengthened a bit, I think at the 143, 144 level. And then on the shorter end of their curve, we had that quote, I say this in jest, massive move from 4 basis points to 9, I think, on their 2-year, and we're back down to like the 4 or 5. But anyway, point is that these countries have an opportunity to kind of take a stance, and I think they're kind of missing it. But, we'll see what happens. But again, we are completely reliant on the Fed. And the last comment you made, Guy, about kind of quantitative tightening and quantitative easing, I went back and looked, and I keep seeing comparisons to pre-COVID. What was pre-COVID? Because that was, quote, a normal environment, although we still had $4 trillion on the Fed's balance sheet. We're still at $7.7 trillion. I looked at the chart. It's going to take, obviously, years to whittle our way down below 4. But as we kind of make that move towards 4 and we normalize kind of into this economy for 2024, something to keep an eye on because you're going to keep seeing these comparisons. But with the Fed pulling liquidity as opposed to putting it in, I think it makes it a lot harder next year.
There's some great financial dailies or, papers, periodicals, Financial Times, Forbes, the Wall Street Journal.
The Bloomberg.
I don't necessarily think of the New York Times through that lens.
Except the deal book, ARS. He's got.
I love Andrew Ross Sorkin. I mean, that's sort of like that's an oasis.
He's on your Mount Rushmore
in the middle of the desert.
Yeah.
But I only mention it because there was an article out this week, and they may as well have interviewed Danny Moses because it talks about Americans taking on too much debt in this phantom buy now, pay later thing that's sort of become, again, to use the term, de rigueur. And I will tell you, Danny's had a lot of thoughts on this over the last couple of years, but now people are writing about it, Danny. And I think there's a lot of reasons. There are a lot of reasons to be concerned about the consumer, not least of which this thing that has sort of caught fire over the last year or so.
Listen, we started this podcast in January 2021, the same time that AFRM went public, right? And so we've all seen this together as this has gone on. So what happened this past week was that Walmart at the self-checkout kiosk, you can now use Affirm as a payment choice, right? And so they were already integrated at Walmart to a degree. They're integrated with Amazon. But think about this. They pride themselves on telling consumers it's a soft credit pull, so there's no change to your credit at all. We check you. We check your FICO basically, and that's it. So I don't know what their average is around the 600 level or whatever it might be. But if you miss a payment, and this is where the CFPB down in DC is keeping an eye on, your actually credit will be impacted. They'll write that off completely. So the growth has been astronomical because as the economy's been weakening, right, and people are maxed out on their credit cards, this is a choice you can make. And there's two ways to look at this, that how a firm conducts business. I don't have a problem with it. This is how it is. They either get the merchants to sell their product at a discount, effectively factoring the product, so there's no credit risk to that, to them or the consumer. And then there's the part that the consumer then pays back a firm literally on a loan, zero interest, et cetera. So for payments over time. Problem is this. The numerator is obfuscating the entire fraction. The growth has been so massive, obviously, because it's filling a void here for people that would normally not be able to take out a credit card, that delinquencies and charge-offs, while they're still rising, appear to be, quote, okay. But what a firm is being forced to do now is to portfolio some of these loans that they're originating, right, from the consumer as opposed to selling them. Rates coming down help them, obviously. So last thing I'll say on this, and I want to compare it to something else, is that the CFO has basically sold stock 4 times. He sold stock the day that they announced this Walmart deal on the 19th, I believe, the two days ago, literally at $50. The last 3 times he sold the stock were February of 2022 at 66. A few months later, we were at 18. March 2021, sold at 87. A few months later, we were 54. And November of 21, 154. A few months later, we were in the 50s. So again, Morgan Stanley had just downgraded the stock literally the day before they announced this deal. And one of the things they said was that they're seeing, deterioration in the credit and so forth. So let me just take a firm, which is a kind of a nouveau credit company, if you want to call it that, to an old school, CarMax, which went public in 1997. These companies basically have the same market cap, by the way, like 12 or 13 or $14 billion, something like that. CarMax has seen every cycle in the world. Stock is up today because they have better earnings and lower revenue. They've decided to stop lending out as much. They've decided to use that money instead to start to buy back stock again. So when you look at these companies that have been through cycles before, and a firm has never really been through a cycle, believe me, I covered buy now, pay later, short now, cover later, and I stick by that. And I think the stock's very expensive. So again, old school lending company versus new school. And I think that the new school will end up getting hurt.
But Danny, it's nearly, unless this is deep end of the pool stuff for you and some of your smart hedge fund pals to kind of short this thing, right? Because it's got 22.5% short interest. Obviously they don't earn money. They're expected to lose, I think, on $1.8 billion in revenues, maybe like $800 million this year. You know what I mean? This is a 40% gross margin business. It's not even that good of a business. You'd think that they would be able to kind of build in it, but it's a hard short, right? Like I think you make a great point. Because look where it was. It was down 95% at its lows a year ago, right? And now it's up, a few 100% or whatever. So it's just, I think it's really important to call out the behavior, like the behavior of consumers by the sentiment as it relates to investors. You know what I mean? Just on the chart, I know guys looking at this, that $50 level's a level here a little bit, but it's just a hard one. Unless you wanted to trade, let's say put spreads, short call spreads, that sort of thing. I mean, there are ways to do it with defined risk, but it's going to cost you.
It's funny. You're 100% right. And the macro of that, to your point, lender of last resort, we talked about the setup that savings rates are at a low, that people are tapped out on their credit card. Let me get a, quote, interest-free loan to buy something, and I'll pay it over a period of 3, 4, 5, 6 months, 100%. So the growth, this GMV, as they call it, is there. I believe, to your point, Dan, you're making, it's trading off of that growth. And I think it will shift dramatically to the credit side of the equation, because that is what a financial company is. And this book value is around $6 or $7. We talked about the multiple book for Upstart, same type thing. So this will happen, but I guess it's important because I believe this company is a microcosm of the economy and the stock market, of people that misappropriate a multiple on what should be a financial or a credit company, not a tech company, and they take advantage of a slowing economy, Guy.
That's exactly where I was going to go. Like, I'm not necessarily interested in these companies and their stocks if they're going up or down. This is the way I look at it, and this goes back to the article that we cited. This Americans may be taking on too much paid later phantom debt from the New York Times. We'll put it in the show notes. But buy now, pay later loans are helping to fuel record-setting holiday shopping season. Economists worry they could also be masking and exacerbating the Americans' financial well-being. Tim Quinlan, who's an economist at Wells Fargo. The more I dig into it, the more concerned I am, talking about phantom debt. So, traditional things are fine, but I think to your point, Danny, a lot of this could be masking some of the problems that we've been trying to point out for quite some time. So the health of the U.S. consumer in terms of their spend, I mean, if that's the only metric you want to say, they're in great shape. But the question is, and again, this article sort of speaks to that, Dan, should they be spending?
Yeah, well, I mean, listen, we're going into the final week of this holiday spending season. We've had really positive consumer confidence, readings. I think that has something to do with the housing market loosening up, with rates coming in, with the stock market, right back to all-time highs. And let's see, we had that unemployment rate tick down a little bit at that last print. I think that the volatility in the economic data probably increases in the new year a little bit. But I'll just say this, like the last thing I'll say, and again, I got the direction of the S&P wrong for the better part of this year. We got something right on the sector level, individual stock level, and the like. And, I can see how just listening to what Fed Chair Powell had to say and some of the commentary about it, I think Danny made a really important point because, it seems like the dovishness has to do with something less about dropping the mic on slaying inflation and more about what lurks beneath, what comes next. And I think that's a really important point to highlight this phantom debt situation. We just spent some time talking about debt to GDP, right, at levels that seem, unsustainable. So my point is, I can see a scenario where the stock market has way outshot the opportunities for the economy and for S&P earnings, and therefore we are due for a reset. But I can also see a scenario where maybe some of the dynamics post-pandemic and maybe some of the productivity gains that we've had with technology and this and whatever, that maybe they did, as you use the term, Guy, all the time, maybe the Fed did alchemy out recessions. You know what I'm saying? And maybe we are going to be in for maybe kind of a slower growth, kind of low unemployment, sort of higher productivity sort of environment. And maybe they've also taken out a lot of the volatility in the stock market. Who knows? Because we spent the better part of 2022 remarking how orderly that sell-off was in the stock market until we got to that sort of crescendo in late October. And that was it.
A lot to be watching into the new year, and we will surely be talking about it. One of the things that we've been talking about is Danny Moses' record in the National Football League, the league where they play for pay. Danny comes into week 16. You used the word, not me. I was going to say a fair 23-21. The last couple weeks have been difficult. I'll say this, and Danny may or may not agree with me. There's a game on Christmas Day, I think it's the last game on Christmas Day, that very well might be the prelude to the Super Bowl. The Ravens of Baltimore will be playing the 49ers of San Francisco. That is if you're an NFL fan, that's a must-watch game. There's another must-watch game just in the form of, I've never seen a beatdown the way I saw the Chargers get beat down by the Raiders. The Chargers are playing the Bills on Saturday, December 23rd. But I don't want to steal your thunder, Danny. What do you got for us this week?
It was just so people know, I put my money where my mouth is. That was, other than the soccer game that I hit on the plus 475 on the draw between Man U and Liverpool, that was erased by the 0-3 NFL weekend and then a push. So I'm going to have to bounce back here strong. I'm not picking either of those games. I think the Baltimore San Fran game's awesome. The line's 5. I think that line's about right. I kind of don't really love that either way. I would take the Niners if I had to pick it. But I'm going to take Dallas going into Miami after that ugly showing Dallas just had, obviously up in Buffalo, getting 1.5 in Miami is totally banged up. Their offensive line is out. I think Tyreek Hill is out. Mostert's out. Anyway, give me Dallas plus the 1.5. And then I think the Chiefs are getting right. And I think the Raiders, yes, they did have that big win guy, but the Chiefs are laying 10 at home on Christmas Day. Give me the Chiefs and lay the wood. So just 2 picks this week, Guy, Dallas and the Chiefs.
You sound like a beaten gambler, but if you emerge this week 2-0, you will come guns a-blazing.
You got that right.
Next week. We want to wish everybody an extraordinarily Merry Christmas. Enjoy the time with your friends and family. We will be back, obviously, next week, but we want to thank everybody for being with us this year. And we look forward to moving forward, Dan, into 2024.
Big things in 2024. Thanks for all of your support. So we'll see you. We got some good stuff next week. So stick around next week. All right. Thanks, everyone.